Hello and welcome to InvesTube. Jim Rickards, considered one of the world's biggest investment and financial experts, has warned all investors in recent weeks, saying in one of his latest interviews that the average investor should prepare for the new economic situation that will arrive in the coming months. This well-known expert says that there are three different narratives about the current economic situation. First, we have the story of the Fed. Then there is the story that is being lived in the stock markets. And finally, we will know the real story that, according to Jim Rickards, will be the one that will trigger a crisis with big declines in the stock markets in the coming months. Let's not wait any longer and let's analyze these three stories that this investor is talking about.
The protagonist of today's video is an American investor, lawyer, and economist, known for his analysis on subjects such as the global economy, international finance, and financial risk, as well as being the author of several books with great worldwide influence. This investor has been an advisor to several governmental entities and has worked in some of the most important private companies around the world. He has recently analyzed the economic situation and comments that there are three different narratives.
Let's start with the Fed story. According to the investor, the U.S. Federal Reserve's goal is still to bring inflation down to 2%. Although in other central banks, such as in Europe, some voices are beginning to suggest the possibility of shifting the inflation target to a higher number in the face of the new era of economic instability. According to the Fed, its target interest rate will be that rate that turns out to be high enough to bring inflation down on its own without further interest rate increases. According to the latest data, the Fed believes it will have to raise rates another 25 basic points in May, and thereafter they expect to stop raising rates, and perhaps we will start to see rate cuts in the first half of 2024, as long as Jerome Powell sees it possible to bring inflation down to 2% without further rate hikes, as he has repeated on numerous occasions. That is his principal objective.
And if we move on to the story that, according to Jim Rickards, the stock market is following, it is that we are already at the terminal interest rate, meaning that there will be no further interest rate hikes. The investor explains that the market is discounting that before the Fed decides to raise interest rates again in May, the market and the economy will send a warning and a wake-up call to the Fed, like the one recently experienced in the financial sector, warning of a very high risk of recession if they continue with their restrictive policies. And due to this situation, the Fed will be forced to put on the table the famous word pivot, which means to reduce rates and try to give the economy a soft landing. This is the situation that the market and most investors have decided to believe, and is the cause of the rises in the major stock markets since January 2023, as the interest rate cuts have historically favored the performance of stocks.
Don't forget that the best way to support this video is by hitting the like button and subscribing to our channel. However, now let's look at the story Jim Rickards believes in, which, unlike the other two, is not as optimistic. At this point, the investor highlights the situation being seen in both the US and European bond markets, and warns of the risk of an inversion in the yield curve to which the investor refers. It is the single best indicator that a recession is coming. The last time we saw something like this was in 2007, just before the financial catastrophe of 2008. Jim Rickards says that the stock market on the one hand is discounting that we will have growth with inflation coming down. However, the bond market is indicating that we are approaching an economic hurricane with serious consequences.
Regarding the inversion of the yield curve that the investor is talking about, you should know that it is a situation in which yields on long-term debt bonds are lower than yields on short-term bonds. This is an unusual situation because in a normal environment, long-term bonds usually pay more interest than short-term bonds because they have a higher risk due to the uncertainty that may exist in the more distant future. When yield curve inversion occurs, it basically means that more is paid for a short-term investment than for a long-term investment because investors are concerned about the economy and believe there may be a recession in the near future. This situation is very rare, but when it is seen, it usually anticipates times of recession and crisis in the stock market and the economy, as Jim Rickards points out.
Having seen these three possible scenarios presented by Jim Rickards, we would like to know your opinion on which of them you think will happen in the coming months. Leave us your opinion in the comments of this video. Continuing with the statements of this reputable investor, he states that the bond market is indicating that the Fed is probably overdoing it on rate hikes and that they have probably been exceeding the target rate for months now. He predicts that they will decide to pivot and announce a rate cut in August, but if so, it will likely be for a very bad reason. He says the Fed will lower rates not because they plan to do so, to achieve a soft landing with good economic growth and low inflation. They will lower them because, as usual, and as they have been doing since 1913, they will realize that they raised rates too sharply. They are not looking at leading indicators such as the inversion of the yield curve, nor the stock market situation. They are only looking at useless lagging data related to the labor market, such as the Phillips curve, which we will talk about later. What is going to happen, he says, is that they find out too late, and when they find out, they will start to lower rates quickly.
The investor next references a similar situation that occurred just 5 years ago, when between October 1st and December 24th of 2018 the stock market fell 20% because the Fed was making rate hikes. Just 3 weeks after reaching the bottom of the declines, the Fed followed up by announcing another rate hike. What this shows us is that when the Fed is on a mission, as it is today, to lower inflation at all costs, they don't really care what happens in the stock market. The only thing they do care about is messy markets. They don't care if stocks are going down. They are not going to rescue the stock market. They care only if the situation gets out of control, as for example, when it got out of control in March 2020 with the healthcare crisis and with the S&P 500 dropping over 30% in 2 or 3 weeks. Then if the markets and the general economy get out of control and collapse, the Fed will stop raising interest rates and start lowering them. But it will not do this just because the stock market is going down.
Jim Rickards at this point agrees with the market that we are going to have a pivot with interest rates, but completely disagrees with the possibility that the Fed will do this in order to seek a soft landing. The Fed will be forced to make such a decision as it will trigger a severe recession in the coming months, which according to the investor, will cause the S&P 500 to fall from its December 2021 highs by 30 or even 50% with devastating consequences for investors. The investor regrets that the Fed has not looked at the bond situation, which for months has been warning of an imminent crisis. Instead, the Fed is paying close attention to the labor market. Specifically, they believe in the Phillips curve. But this data, according to Jim Rickards, does not work. For those of you who are not familiar with the Phillips curve to which this investor refers, what this curve says is that there is an inverse relationship between unemployment and inflation. That is, if we are in a situation of high unemployment, inflation is low. On the other hand, if unemployment goes down, inflation will go up. Therefore, if you wanted to reduce inflation, you simply wait for unemployment to rise.
This seems relatively simple. However, Jim Rickards comments that although this is the thinking that the Fed believes in, he says that this indicator does not work. If we review the levels of unemployment and inflation what we had in the 1970s crisis, we had high unemployment and high inflation at the same time. Or for example, between 2009 and 2019 we had low unemployment and low inflation. At the current time, we have low unemployment and high inflation. So we see this Phillips curve rule does not work as it does not show any correlation.
The investor ended his interview by warning that the average person should protect themselves against an upcoming crash, whether that person is a worker and sees their job threatened, or whether that person is an investor and sees their portfolio threatened. For investors, he warned them to prepare immediately by diversifying their portfolios with different asset classes and keep a high percentage of cash, and not to wait until the Fed realizes the current risk, because they will be the last to know, and it will be too late.
By May or June, I hope everyone will be prepared for everything we are talking about. Get ready now, because when it comes it will be too late, and your stocks will be down more than 30%.
Once we know the opinion of this investor, we must be clear that we cannot try to predict future macroeconomic factors when investing. We must be informed but never base our investments only on the macroeconomic predictions of other investors. As we have seen in the channel, some of the best investors of all time, such as Peter Lynch or Warren Buffett, say that it is impossible to predict the future macroeconomic situation. They say it is a waste of time. We should focus on investing in great companies with stable competitive advantages over time, capable of surpassing a possible economic crisis in the future, and take advantage of these moments of volatility such as those presented by the protagonist of today's video.
Here are 2 videos where Warren Buffett and Peter Lynch will give you the most important keys to get good returns even in difficult times such as those predicted by Jim Rickards. Don't forget to hit the like button and to subscribe and activate all the notifications of this channel. See you in the next video. Greetings and good investments.